A warm good evening to all the participants who have taken this evening to join this webinar. Today, we have the largest fund house in the country with over 6 trillion rupees in asset under management and one of the most favored fund houses to park their savings for wealth creation for over 35 years of rich history for the Indian investor community. In a time where multiple headwinds contribute to the volatility in the equity as an asset class, and the research strength becomes increasingly important to mitigate the market risk, and SBI has got solid and experienced research capabilities. Today, we have Mr. Gaurav Mehta, CIO of SBI Alternates for Equity Asset Class is here to present three of their core offerings in the PMS and AIF space. Gaurav has got over 15 years of experience in financial market and has worked earlier with Ambit Asset Management and Heightened Asset Management. Is a BTech from IIT Mumbai, and he is an IIM graduate who is a charter holder of the CFA Institute USA. Gaurav will make a presentation for the first 40 minutes. The last 20 minutes are reserved for Q&A. And please, one small request to all of you, please avoid stock-specific questions to Gaurav. Now I hand over the stage to Gaurav to start the presentation. Gaurav, it is over to you.
Thank you, Siva, and a very warm good evening to all the participants. Thanks for joining us on this Friday evening. I have a slide pack ready for you. As Siva mentioned, I'll try and cover it up within the first 30-40 minutes, and then happy to take any questions that there might be. And if you look at the flow of this presentation, we have tried to break it into two different components. The first component focuses on what's happening in the macro environment today. I'm assuming that's of interest to a lot of us. And then, I'll take you through the alternatives offerings from SBI AMC and how they, in the macro construct that I just described, are going to be pretty sort of useful to navigate this uncertain time. So let me begin with the first slide here. I think today, there are two different challenges that the global policymakers face. The first challenge itself is around the fact that there is very high government debt. And what I've plotted here is US government debt to GDP, and it's just ballooned through the roof at about 120% plus. And the last time you had such high debt burdens in the US was somewhere around World War II. And obviously at that point, a lot of this debt burden was necessitated because of war. And now, because of the COVID crisis, the government had to dole out households, they had to give out these benefit transfers, and that's again led to a very significant increase in debt to GDP. Now, when government debt to GDP is so high, and this is, I've obviously plotted US here because that data is very easily available, but this is true across economies in the world today. Now, when government debt to GDP is so high, it necessitates keeping real interest rates low for very long periods of time. And that's exactly what had happened in the global economy between 1945 and 1980. So after this episode of very high government debt in 1940s, you had to keep real interest rates low so that the government's debt servicing ability is not compromised. And debt to GDP eventually is a ratio. If you allow the GDP, which is the denominator, to grow at a fast pace than the numerator by keeping the interest burden low, then obviously, debt to GDP over a period of time comes down. So this dynamic where government debt to GDP is so high, on one hand, needs low interest rates for a very long period of time, probably negative interest rates as well, negative real rates as well. So on an inflation adjusted basis, real rates should be very low or negative. But then on the other hand, as all of us are seeing, we are faced with this massive inflation surge. I think this is US CPI, year-on-year increase in inflation over the last 25 odd years. And you will see that we are at a multi-decade high at 9% plus. Now, this obviously is forcing the US Fed to raise interest rates in a very rather sharp fashion. And so, so if you think of this equilibrium, on one hand, you need low rates, otherwise government debt becomes unsustainable. On the other hand, high inflation itself necessitates very high interest rates. I think we are in a very significant policy challenge. The hope here is that inflation will eventually come down, and that will mean that policy rates can come back to normal. Whether that happens or not is, I mean, the jury is still out. But again, we saw the government debt burden in the US in 1940s. I think if you again go back to the same period with respect to inflation, you will see that you saw a very significant surge in inflation, just like we are seeing now in the US. One reason for that surge in inflation was that the dynamic were very similar to today, wherein because of war, there was a lot of pent-up demand. That pent-up demand on the other side of the war led to a significant increase in demand, and the supply side couldn't match up because some people were only making wartime supplies then. Today, the situation is very similar. There's a lot of one-time pent-up demand, but on the supply side, in some sectors like conventional energy, there have been no investments because of ESG concerns and so on over the last several years. And on other side, because of logistics issues and so on, there are supply chain disruptions. So supply and demand are not matching perfectly, and that's leading to a surge in inflation. But after that one-time surge happened in the US, there was a significant decline in inflation, partly driven by supply matching up to demand. Secondly, demand itself was pent up. So once that pent up demand comes down, obviously there's a significant moderation. And third, I think all of us should remember that inflation is a year-on-year increase in prices. So once prices move up to a plateau and then stay there for a period of time, inflation automatically drops because there is no further increase in prices. So I think today there is a good chance that we will have a similar set of factors wherein the pent-up demand from the US is now easing. Supply disruptions are coming back. And on top of all of this, there is this massive, both from a monetary point, especially from a monetary point of view, this massive need to tackle inflation and hence raise interest rates. So can we saw an inflation seesaw like in the 1940s, where a sudden surge in inflation is followed by a sudden dip in inflation? I don't think we should completely rule it out. Are there any indicators today that suggest that you can see some such situation? I think there is one, and which is what I've displayed in the chart here. I think in my view, this is one of the most important charts to track for global economy. This is nothing but global money supply growth. So what is the extent of money that's moving around in the economy at the global level? And, if you look at this chart, somewhere around the beginning of 2021, the money supply growth was very strong at 20% odd. Now that we're using the exact same chart then to make the case that, there'll be a significant revival in both growth and inflation. But if you think of where things are today, obviously there's been a significant reduction. So that 20% money supply growth is now running less than 4%. If you look at the last several years, the lowest point has been around 1 or 2 odd percent. So you've already seen a very significant decline in global money supply growth. And this has happened even before, the Fed has only recently embarked on its tightening cycle. The balance sheet reduction is just about beginning. So even before that, there was a significant reduction. I think there were 2 key factors responsible for it. One, the big slowdown in the Chinese economy. And 2, the fact that fiscal policy in US is now not as stimulative as it was, let's say, a year back. If you remember all the unemployment and COVID-related checks that were being sent out to US households, that stopped somewhere in September of last year. I think that combination means that there is already a weakening in money supply growth. And now with Fed doing what it's doing, there's a good chance that this will keep plummeting further and perhaps go into the negative territory as well. Now, what are the implications? Very simply put, if there is a lot of money moving around in the global economy, that leads to nominal GDP growth. So that leads to more inflation and more economic activity. Once the amount of money moving around in the global economy comes down sharply, that should have, by the same token, exactly reverse implications, which is that if there is not that much money moving around, so inflation should come down and so should economic activity. So I think, going by this, there is a case to believe that, this entire fear that we have around persistent inflation today, maybe 3-6 months down the line, people will stop talking about it. Inflation will perhaps cease to be a problem. The bigger problem, however, is that what happens if the economic activity slows down. So inflation peaking is a positive thing, but if alongside economic activity globally starts to slow down, that obviously is a negative that we'll all have to live with. So I think, sitting where we are today, there is room to be optimistic on inflation, but not so much on economic growth. And, Unfortunately, that's the reality of the world today. 12 months ago or 18 months ago, people worried about growth. No one was talking about inflation. When inflation came, everyone was talking about it being transitory. And today, almost everyone is concerned about inflation. And there's a good chance 6 months down the line, we'll sort of go back to reverse the clock again and say that, okay, inflation is not a worry. If there is one worry, that's growth slowdown. So I think the implication for investors is that you have to, start living in a world where you shouldn't fixate with a fixed narrative. These narratives will often keep changing. And that in turn, will mean that not only will there be volatility with respect to markets, but there'll also be volatility with respect to policy. Because today the Fed is hiking even when government debt burden is so high, because it has to be seen as fighting inflation. On the other side of this inflation peak, obviously the Fed will again resort to a perhaps a little dovish policy, because it'll go back to supporting the high debt burdens that the government faces. So I think we have to start to sort of live with this volatility both on macro variables as well as at a policy level. I think the implication of this on what kind of stocks do well is also very significant. If you go back and look at the period from 2008 to 2020, this was an episode where people were not talking about inflation at all. There was hardly any inflation, hardly any economic growth globally, and interest rates were close to zero. So this is, what is called was a perfect deflationary environment where no growth, no inflation, zero rates. Now, what works well in a deflationary environment, when interest rates are coming down, obviously bonds do well. But alongside bonds, a lot of these assets, which are bond-like in nature, they also start to do very well. So people flock to safety even within equities. And the classic example of that in the Indian context was that a lot of these FMCG and quality stocks where cash flows are certain, those stocks got massively re-rated. Some of these FMCG stocks used to trade at 25, 30 times in 2009. They got re-rated to 60, 70 times in 2020. And overall, this entire narrative where, if you see visibility on cash flows, you can buy those stocks at any valuations, that became very strong. And that was not just an Indian phenomenon, that was also true globally. You saw how, the NASDAQ stocks or the big tech stocks just, went through the roof with respect to valuations. And now, if you look at what's happened over the last 18 months, that narrative has completely changed. It's not that a Facebook is a different Facebook or an Apple is a different Facebook than it was 6-9 months ago. But because interest rates have started to rise, a lot of these valuations, especially the ones that were very expensively valued, are seeing a very significant derating in valuations. Long story short, I think this entire 12-year period between 2008 and 20, where we were just talking about deflation, low interest rates, which led to a certain set of quality stocks re-rate to stratospheric levels. I think that very clearly is history. If anything, we are in a world where we won't. It looks like we've put deflationary forces to rest for better. If anything, inflation is the key environment, is the key theme now. And even when inflation peaks and settles at a lower level, it's very likely that it will still settle at levels much higher than the past decade. Similarly, yes, there will be some growth slowdown in the near future, but again, that growth will be significantly better than the last decade. So I think we have completely moved from a deflationary environment to a relatively higher inflation, higher growth environment, which in turn will mean that interest rates will also settle at a higher level than in the past. A combination of this would mean that there will be significant reversal in the complexion of assets that do well. So rather than assets which are largely beneficiaries of low interest rates, I think you will see assets which are largely beneficiaries of a better economy do much better over the next 3, 5, 10 years. So I think that's the broad crux of what this chart is all about. Whether you look at small caps in the US, they've significantly underperformed the big tech over the last 10, 12 years. That underperformance is now reversing. Small caps are supposed to be economic beneficiaries. Big tech is supposed to be more beneficiaries of low interest rates. And a whole host of other things like value growth, a lot of these factors point to the same argument. So I think that's one change that you will see going forward. So I think if I were to sum up this macro construct, you should expect quite a lot of volatility in macro data points. You should expect quite a lot of volatility in policy, and you should be ready for a significant style shift. So what worked over the last 10 years may not necessarily work over the next 10 years. Alongside with, you should also expect a heightened volatility in markets. And I think this is again a very simple chart, but a very powerful one. If you plot US 3-month yields, which is the blue line here, along with Nifty volatility, which is the red line here, you will see that there is a very strong correlation. So last 12 years, 2008 to 20, were largely represented by close to zero interest rates in the US. And that also coincided with a period of very low Nifty volatility. But if you go back to 2002 and 2008, that 6-year period, you will see that this blue line, which is interest rates in the US, were constantly inching higher. And alongside that, Nifty's volatility was also constantly inching higher. So, all of us who look back in history and look at that 2002 to 2008 period, for us, that's the best bull market in the Indian equity markets ever. But if you were living that bull market, you will realize that there was very high volatility. I mean, I remember that between 2003 and 2008, I think there was one, if I'm not wrong, there was one lower circuit on the indices every year. So single day when the index would halt trading because it was 10% down. And then these episodes where there were 20-25% correction in mid and small caps were very frequent, just like the one that we've seen over the last 3-6 months. So end on end, it was a very fulfilling period for people who stayed invested, because the Nifty moved from 900 or 1000 or to 6000. So 6x increase in the Nifty. But when you were living that period, your ability to stay invested was being challenged every now and then. So, just to summarize this macro construct before I move to the product, last 12 years, low interest rates, low growth, low inflation. Low growth means low earnings growth as well. And as a result, indexes returns were very anemic. But because interest rates were low, volatility was also low. You go back to the previous decade, 2000 to 2010, high growth on economy, which meant high earnings growth, which also meant strong returns at the index level. But because inflation was also rising, interest rates were rising, which meant volatility was high. So high volatility, high returns. Last 10 years, low volatility, low returns. I think going forward, if you were to take a crystal ball and say what's going to happen over the next 3-5 years, as I said earlier, it looks very likely that we've moved out from the deflationary regime into an inflationary regime. So if anything, we should expect decent growth, but higher inflation and higher interest rates, which in turn means that equities can still deliver good end-on-end returns, but along with it will come very high volatility, which will challenge your ability to stay invested in equities. We've all seen how last 6 months have shaken everyone up, right? So just imagine if these episodes keep happening every year or 2 years. So I think that's the summary of the macro backdrop. How do you sort of navigate this macro? I think I'll just touch upon this. I think before I do that, just one last slide here. The earnings outlook on India is a silver lining amidst all this macro uncertainty. Between 2008 and 2020, we have been constantly declining with respect to profits. So this is India's corporate profits as a proportion of GDP. We were constantly declining for this 12-year period. It's only over the last 2 years that we have finally turned the corner and started reverting higher. If you look at history, these earnings up cycles and down cycles, they last for several years. So on this front, there is room to believe that we've finally ended a deceleration in earnings and we've entered an era of increasing earnings. But as I said, this earnings trajectory over the next 3-5 years could mean good index returns. You should also be ready for very high volatility that will come along. So in this environment where you want to participate in equities, but at the same time you want shock absorbers for the massive speed bumps that will come along the way because of this heightened volatility, I think the first product that I wanted to discuss today is what we call the SBI Optimal Equity Fund. This is a Category 3 AIF structured as a long-short equity fund. There are two key aspects to this fund. You should think of it as two strategies in one. The first strategy is that when we receive 100 rupees, let's say, of that 100, 65 to 70% gets invested in a long only portfolio. Now, this is a typical bottom up long only strategy where you're buying 20-25 good quality stocks. One good aspect about alternatives versus, let's say, mutual funds is that size is lesser of a constraint. This is a very privately placed niche distribution product, right? So sizes are typically small, and that allows you to play across the market cap spectrum. So you can buy good quality mid and small caps and sit with them for the next 3, 5, 10 years as they graduate into large caps of tomorrow. So the idea here is that you park 65-70% of the portfolio in 25 high quality stocks across the market cap spectrum for the long term. So obviously the investment horizon here is 3-4 years, even higher as the thesis continues to play out. You will still be left with 30 rupees, right? Having deployed 70 rupees in the long only portfolio. That 30 rupees you use basis an asset allocation framework. I'll briefly touch upon the allocation framework as well. But basis an objective asset allocation framework, when the framework is asking you to completely reduce risk from equities, you use this 30 rupees to create nifty short exposure to the extent of 70 rupees. So just to sort of reiterate, you have 70 rupees of long stocks. In times when your model is asking you to completely reduce risk, you're using the remaining 30 to create 70 rupees of short exposure. So 70 rupees of stock longs, 70 rupees of nifty short, your net exposure goes down to 0. And that helps you sort of withstand market volatility as markets go down. But then this asset allocation framework is a very objective framework, and it's not dependent on, it's not working only as a hedge to the long portfolio. It's in a way, pretty agnostic to market direction. So there'll be times when valuations will be very attractive. Everyone will be pessimistic. There'll be blood on the street. There'll be very good bargains available in the market. At that point, the asset allocation framework could also ask you to significantly increase equity exposure. In times like those, we'll use the same 30 rupees to, let's say, create 60 rupees of nifty long exposure through futures. And at that point, you still have the 70 rupees of long stocks, 60 rupees of nifty long. So on a net basis, your allocation goes up to 130. So the way it works is that in one extreme, when valuations are very expensive, when earnings are topping out, when market sentiment is euphoric, there's unsustainable optimism in the markets, and everything is very richly valued. At that point, the framework will ask you to reduce exposure towards 0 by creating 70 rupees of nifty short exposure. And at the other extreme, when valuations are very attractive, there are bargains available, there's blood on the street, you use the same framework to increase your allocation from 70 to 130, again using nifty futures, but on the long side. Now, the important question here is that how does this asset allocation happen? And we use a very simple three-pronged approach. Look at valuations. What is earnings yield in equities versus where bond yields are. On the whole, are equities attractive or not? So that's one measure of one part of this asset allocation framework. Second piece is try and quantify market sentiment. Warren Buffett has very famously said that be greedy when others are fearful, be fearful when others are greedy. The challenge, however, is that how do you know whether market as a whole is greedy enough for you to reduce risk, and whether the market as a whole is fearful enough for you to increase risk? And, which is why, through a host of factors like market internals, like positioning, internal sentiment, there's a host of factors that we combine into one measure to get a sense of market sentiment. And this works as a contrarian tool. I think I'll just show you that slide here. If you look at the left-hand chart here, this is market sentiment plotted historically. What you also see here is, in the gray shaded regions is the forward 12-month Nifty returns. So if you analyze closely, you will see that whenever the sentiment reading dips significantly and it's too low, which is to say that there is widespread pessimism in the market, that's usually followed by periods of strong index returns, and vice versa. Whenever the sentiment is very elevated, that's typically followed by periods of weak investment returns. So after COVID, this trough that you see here is, when there was so much pessimism in the market, there was so much blood on the streets. That was a great point from a contrarian standpoint to go long. But the picture changed in the second half of 2021. The market actually swung to the other extreme with respect to emotions and sentiment, and there was unsustainable euphoria back then, which suggested that it was good time to reduce risk. Today, thanks to the correction of the last 9 months, you have now somewhere reached closer to the neutral region. So, it's like today the picture is how, you could look at it as glass half full or glass half empty. The froth of the last 9 months is completely out, but you're not at the pessimistic extremes either, where you could say that, okay, I'll just put all my money in equities at one go. We're somewhere in the middle. So that's the second piece. And then there is a third piece, which is more shorter term tactical measure on, whether you're in a high volatility state today on the index or in a low vol state on the index. And, this is a very short term timing tool, which basically tells you, the basic assumption here is that whenever markets go through a risk off environment, volatility tends to move up. So whenever volatility moves up, that's a signal for us that you should reduce equity risk, because you're probably going to be in a risk off environment for some time. So I think that combination, right? Valuation, which is a very long-term measure, sentiment, which is a more tactical medium-term measure, and this vol state, which is a more short-term measure, in combination help you decide market allocations. The important question, however, is that after doing all of this, what exactly is the outcome? The outcome is twofold. One, you get significant reduction in risk. And I think I'll show that slide here. What we've plotted here is the drawdown of a backtest on this strategy versus the Nifty's drawdown. In 2008, Nifty fell by 60% from a top to a bottom. A strategy like this would have fallen a little over 30%. Same thing during COVID. The blue line, which is Nifty's fall, was closer to 40%. The orange line, which is the strategy's fall, was closer to a little less than or closer to 20%. So, and then you look at other risk measures like standard deviations and downside standard deviations, so on. And you'll again see that there's a substantial reduction in risk versus the index. So in a way, what you're saying is that in very bad periods, I want to fall closer to half of the index's fall, not more. But doing all of this, are you sacrificing on returns? The answer again is no. So after doing all of this, you are still ending up with end-on-end returns, which look like a long-only portfolio. So essentially, if you think of this product, this is a product which allows you to participate in the equity story from a longer-term point of view. At the same time, it significantly reduces risk. And when I say significantly, as I said earlier, the intent is to fall, half of the indexes fall in bad times. And, this is very important, because if you go back and, think of the 2008 market meltdown, the Nifty fell by 60%. A lot of long-only portfolios fell by 75-80%. So if you had 100 rupees invested in the Nifty, it would have come down to 40. And that same 100 rupees in a lot of long-only strategies would have fallen down to 70. Right? 100 coming down to 40, 100 would have come down to 40 in the Nifty and would have gone down to 30 in a lot of long-only strategies. Versus which, if you have a product where that 100 rupees only falls to 68, 69, I think that's a big difference, right? 68, 69 rupees versus 40 versus 25. And I think that's what allows you to stay invested even through such a brutal market meltdown. And I think that's the intent here. In an environment where equities is still the asset to play, because you're finally entering a period of strong earnings. You want to stay invested, but at the same time, with interest rates moving higher and with volatility inching higher, you need some shock absorber, so that once these big drawdowns hit you, you're not sort of emotionally and sort of monetarily shaken out of the market. I think that's the first product that I wanted to discuss, which is a long short AIF. Two pieces to it: a long only strategy and a very objective asset allocation without any significant human intervention. And that asset allocation is largely happening on Nifty futures, and that's not impacting what's happening on the long only strategy. The combination is giving you a significantly better risk reward, not compromising on equity returns, but allowing you to witness the downsides better. The second product is a PMS. This is called the Yon Alpha PMS. Now, very simply put, the same asset allocation framework that I talked to you earlier. We are allowing ourselves using that asset allocation framework up to 35% cash calls. But again, these cash calls will be taken in very extreme market settings. So imagine a market where valuations are toppish, where earnings are toppish, and where sentiment is very euphoric. Only in those extreme cases, which happen, let's say, once every 3-5 years, you will move down to 35% cash. In all other market settings, this will typically be like a long-only portfolio. But the important aspect here is not so much the cash call, but what kind of stock do you buy? So I think we are very clear that we'll run it as a very focused strategy, not more than 20 stocks. And as I said earlier, the sort of excitement here is that you can buy those 20 stocks, which means on an average, one stock will be 5% of the portfolio. And to the extent sizes here are not as constraining as on the mutual fund side, you can literally play across the market cap spectrum. So you're very market caps agnostic. You can buy small caps, good quality small caps to the extent of 5% of the portfolio. But the other important aspect is that, this entire style debate, right? There are some people who think that good quality companies can be bought at any valuation and they'll generate returns because earnings will compound and so on. And then there's this other school of thought where, people do want to play emerging themes and and macro cycles and so on, something that's worked so well over the last 12-18 months. So what we decided to do here was to have a good marriage between the two strategies. So of the 20 stocks that we buy, about 10 will be what we call core holdings. Now, these are stocks where, that these managements are great managements. They've had a very profitable track record of delivery in the past. And even today, the addressable market size is so small, they can continue to have a strong runway for future growth. But these are well-discovered names and probably not trading at very attractive valuations. So the only play here is a constant earnings compounding. And that in turn means that the return expectation here should not be massive, right? This will probably be a this will probably be an early teens kind of a return expectation portfolio, 12-13%, which is the core piece. But the other 10 stocks of the portfolio are what we call the satellite piece. Now, this satellite piece can be macro themes. For example, if you're positive on the capex cycle today, you should be playing industrials. Or it could be micro themes. For example, specialty chemicals is a great micro theme that's played out over the last 3 years. Sitting today, could garmenting be a theme, which plays out like specialty chemicals did over the last 3 years? Same set of characteristics for garmenting, right? China is 30% of the global market. India is only 3%. People are looking for alternatives to China. There are other alternatives in Vietnam, Sri Lanka, Pakistan, and whatnot. But all of them have sort of exhausted to some extent. So a big alternative to China, very clearly is India. The government is talking about FTAs and whatnot. So this is just example of companies where, because the themes are still emerging, the valuations are still not very challenging, right? Valuations are still attractive. And when this earnings story starts to play out, you will have both plays. Earnings will count or grow at a very strong clip, and valuation re-rating may also occur. And this combination will mean that the satellite piece will give you non-linearity. And that's how we're thinking of this portfolio: a core engine which consistently compounds and provides solidity to the returns, and a satellite engine which adds non-linearity to the returns. And this combination, we believe, should sort of put us in very good stead with respect to long-term compounding through 20 stocks spread out across the market cap spectrum. And the biggest draw of this strategy, in our view, is on the next slide. And I think this is, amongst the first in the industry. So what we're saying is that we are so convinced about our ability to generate alpha, or even if we are not convinced, we want to make sure that you don't pay us when we don't generate alpha and we falter in our initiative. So what we've come out with is a very novel fee structure. What we're saying is that in this fee structure, there'll be zero fixed fee, literally zero, right? So absolutely, in a way, this is a fully variable fee structure. But the important aspect is that even that variable fee is not benchmarked to an absolute hurdle. That variable fee basically comes into play only when we outperform the Nifty. So, think of it this way: if the index delivers 12%, we deliver 12%. There's anyways no fixed management fee. And then because we are not sort of outperformed the index, there is no variable fee at play as well. On the other hand, let's say Nifty does 12, we do 15, and there's 3% outperformance. Only on that excess outperformance of 3% do we charge 1/3 of that as fee, which is 1% in this case. So I think, in a way, what we're saying is that, look, Nifty returns for investors are for free. A lot of people move to ETFs, etc., saying that I don't want to pay a high management fee, etc. We're saying, okay, you enjoy the benefits of active fund management. You enjoy the benefits of concentrated portfolios spread out across the market cap spectrum, and yet get Nifty returns for free and compensate us only if we generate alpha for you. I think that's our way of putting conviction behind the strategy. And I think lastly, in the interest of time, let me focus on the third product, which is what we call the SBI ESG PMS. And as the name suggests, the focus here is on sustainability. Sustainability in simple terms means that companies that are following the right practices on environmental standards, right practices on social consciousness, and following good governance. And one aspect of that good governance obviously is the fact that these companies should have clean accounts. So we have a forensic accounting framework in place as well that helps us weed out any suspect accounting candidates. But broadly on this ESG framework, we have subscription to external rating agencies, but even more importantly, we have a 3-member dedicated team doing only ESG at our fund house. And a lot of people think that ESG is some jargon, some flavor of the season. But at the fundamental grassroots level, what is ESG? ESG is making sure that these businesses are sustainable. And that's essentially what we are doing through the ESG strategy. I mean, sustainability is the core of anything that we do, right? Whether it's performance in stock markets, success in business, or success in life. So I think that's the entire focus here. Focus on businesses that will continue to create wealth on a sustainable basis. And when you think of this combination, right, PMS, which is relatively small in size, which can play across the market cap spectrum, so identify a lot of small caps as well. The challenge with small caps typically has been that many of these businesses are not sustainable. So you playing in small caps, but putting a sustainability filter on top of it, and I think that's a winning combination. So not only can these companies grow non-linearly, but to the extent that they are sustainable, the risk is also mitigated to some extent. And the interesting part about this ESG strategy is the concept has been at work for the last 5 years. So we were amongst the first ESG PMSs in the country. The strategy has been live for over 5 years now, and you can see the track record here. So on a 3 years basis, for example, we are better than the index by close to 7.5 percentage points. And the same outperformance you can see over the last 4 years, 5 years as well, close to 6-7% alpha year after year versus the index. So I think with that, I will come to the last slide of this presentation. And this is very important because this is the crux of all that we do, which is that we are market leaders on the mutual fund side with a 17% market share. We are not, forced to create products just for the sake of it because scale is already there. The products that we take to the market are products where we think that we can very clearly create something differentiated versus what the mutual fund already offers. And in this case, if you think of the PMS portfolio, if you plot, these 3 products on a risk return matrix, you will very clearly see that on the PMS portfolio, while the investor is taking slightly higher risk than a typical mutual fund, because, obviously there's concentration, there is small cap exposure and all those things. But in lieu of that extra risk, which is very small, you are generating significant amounts of extra outperformance. At least that's the intent. So from a risk return reward point of view, there is a very clear move up versus a conventional mutual fund product. And similarly, when you think of the long short AIF, is actually playing at the other end of the spectrum, wherein you're not generating significant outperformance versus a long only portfolio. Maybe you're somewhere in that ballpark, but you're doing so at a significantly lower risk because, as I mentioned earlier, we're trying to reduce drawdowns by close to half. So again, when you think of risk-adjusted return, there's a clear move up versus the conventional product. And that's our, entire endeavor. There should be a very clearly definable value proposition that convinces us, that convinces our partners, and that convinces the clients. So I think with that, I'll come to the end of this of this presentation. The only small point that I want to make, before I open for questions and answers is that, for some reason we've seen that there is this belief in the market that alternatives is a place that has to be dominated by boutique shops, and conventional AMCs will typically not focus big time on this product area, and so on, right? We, are here to sort of refute that belief. We think that conventional AMCs will play a very big role in alternatives. And if anything, the fact that these products are being served to the market by trusted names will not just help you and me grow, but it will in general expand this entire alternatives market in India. So I think that institutional support will I'm saying that it's not just a matter of choice. I think it's a matter of necessity in order to expand this market, and we are committed to it in a serious fashion. So Siva, I think that was the monologue from my side. I hope we have sufficient time for questions and answers now.
Yeah. And in fact, you packed 3 strategies into one presentation. I'll take some very interesting questions have come out of, and I will go in order of your presentation. First, you have talked about the long short. I'll take long short questions first. Okay. According to you, which customer segment the long short funds are most suitable, and what should be the risk profile of the customers to invest in the long short AF?
I mean, interesting question, Siva. So, very clearly, this is a strategy where risk mitigation is the core of it, right? So, people who are looking to create wealth, or sort of create exponential wealth, obviously, this is not a product for them. This is a product for people who've already created wealth. They want to grow that wealth still at a very fast pace or at a decent clip, at least comparable to, what equity indexes will deliver. But at the same time, they're also very conscious about the downsides that come through, because once you've created wealth, you also want to protect downsides to a large extent. So I think this AIF will fit in well for people who are who already have a sufficient corpus, and they park a portion of that corpus here with the assumption that this will still continue to grow at a decent clip, but will also mitigate risk to a large extent.
A lot of investors have not understood how it is taxed. And can you explain little about the taxation of this long short?
Okay, so I mean, I won't say that whatever I speak is definitive, because there is a bit of ambiguity on taxation here. But our understanding and what the industry practice based on players who have already been operating in the long short space for the last few years is this: that anything that you do on the derivative side will attract full marginal tax rate, which is around 42.74% or thereabouts in India. But on the equity piece, if you hold these equity stocks for over 12 months, then there is sufficient room to believe that you can claim long-term capital gain tax benefits on it. So I think that's what we are. That's how this portfolio is structured. The 70% where you are holding stocks for the long term, we hope to get long-term taxation there. The derivatives piece is to be taxed at MMR, but in all our sort of past backtests and simulations and the risk reward that I was talking to you about, we've already assumed that the derivatives piece will be taxed at MMR.
I'll get into the next product. I'm talking about the alpha product, which you have talked about. You have a very unique fee structure. Pay for only the alpha over the index. And this is a very confident decision. What gives you the confidence, and how do you foresee? And in fact, a lot of funds are struggling to meet the index now. It looks like a bold decision. Can you elaborate what is the thought process behind this?
Right. So, when we look at, strategies that we've done in the past where sizes were relatively small, there was no compulsion to, align to a certain benchmark, and we could run concentrated portfolios, we see that we've anyways generated, significant outperformance versus their other strategies. And, I think I also showed you the performance of the live PMS that we have. And I think there again, you will see that we've been able to demonstrate this. And, which is largely a function of the fact that, you're not hugging the index. So your outcomes can be very different from the index if you do your work right. and to the extent that you are not size constrained, you can play across the market cap spectrum. So you can buy good quality small caps, buy 5% of the fund, about 5% of the fund in such names, and see exponential returns as these companies become leaders of tomorrow. I think those aspects work in favor, and that's what gives us confidence. But I think at the crux of it is the process, is the investment process, and that investment process is something that we are now trying to institutionalize, so that the same research pool that was so far available to the mutual fund side also becomes available to the alternative side. So we are trying to create that structure so that this alpha generation, which we've been doing over the years on the mutual fund side, also gets institutionalized in the alternatives platform. I think that's where sort of the conviction comes from.
And the next question, Gaurav, and when there are 34 boys are playing in the multi-cap mutual fund, what is your competitive advantage your PMS strategy has got vis-a-vis the multi-cap mutual funds? And what could be the differentiating factors what an investor wants to know?
I think we just answered that, because the fact that you are not tracking a benchmark on a daily basis, and you can run active tracking errors versus the index in itself is a significant edge here versus conventional mutual fund. The fact that you're not size constrained and you can play across the market cap spectrum is another advantage. And the fact that you're running very concentrated strategies is the third one. And eventually I'll sort of go back to saying that for us the key sort of strength is our research process, and I think that's what stands ourselves apart. And just one sort of final data point on that, there are now agencies like CRISIL rating multi-cap products. So I think on the PMS side, our ESG PMS was a 5-star rated product by CRISIL, and yeah, I mean the performance is there to see. So
the next question is on the boutique AMCs versus institution-backed company like you. And what is usually the compared to the mutual fund, AIF and PMS are small in size. And how is SBI's concentration on this nascent line of business is number one. How it is different from boutique firms? How your research of SBI mutual fund going to help you in the process of selection of stocks in the PMS and AIF space?
So I think first and foremost, I mean, if you look at global trends on asset management side, I think alternatives are only growing by the day. So they are, I think, close to 15-16% of global AUMs and probably 40% plus of revenues for the global asset management industry. So I think, that trend is coming big time in India already. As you see a lot of high income families grow, as you see this startup culture leading to a lot of wealthy individuals, I think that need for differentiated products which are not just playing in listed equities, but also outside of listed equities. I think not only is it, to improve on return profiles, but also, they also help as diversifiers in portfolios. So I think that trend is already there globally and is, already, if you look at India's AUMs, I think PMS AUMs have doubled over the last 5 years. AIFs, I think, are growing at some 40% plus in terms of CAGR. So I think everyone realizes that this is not an opportunity to be missed. But more importantly, I think institutions, I mean, we, for example, sometimes come across clients who are spending, who have already graduated to PMSs and AIFs and alternatives in general, but they for some reason spend 75-80% of their time doing due diligence on the boutique shop from which the fund is coming, rather than focusing so much on the merits of the product itself. So when you have an institutional player where you have a long track record, you have strong processes, you have a strong team, then I think it automatically sort of takes away that big pain point from a customer's point of view also. And which is, as I said earlier, we think not only do conventional AMCs have a right to win in this sphere, but I think they will only sort of help expand the market significantly versus what you've seen so far.
SBI has got one of the largest research teams, what we understand. and how the institution-backed large research team like yours shortlist this and decide what should come into the portfolio vis-a-vis a traditional boutique kind of firm. How different it is.
Right. So, I mean, firstly, the research team as we speak today is still, we are still working on the structure where that research team can be carved out and help alternatives the way it does mutual funds. So that structure is still not in place. But beyond that, I think, you're right that we have, I think as an AMC, we have about 30 plus analysts, closer to 30 research analysts. And obviously some of them are focused on covering specific sectors. There's quite a lot of capability on the lateral research side where we're doing, macro and thematic work. We're doing asset allocation research. We're doing quant stuff. We are, working on ESG and forensics and so on. So I think that pool is already there. And then, with respect to specific idea generation, obviously, there are experts working on sectors from a bottom-up basis. Then there are inputs from the lateral research side. And when you combine them, you get to a very you at least get to increase your probabilities of success. And that leads to an investment universe. And then, we follow our usual sort of process around, scuttlebutt, channel checks, meeting industry experts, trying to connect with the entire ecosystem of the company, meeting managements obviously is a part of it, annual report analysis and so on. And, that eventually sort of leads us to the final shortlist of companies that we think are worth investing in. And even that list is quite a large list. And the attraction here is that you only have to buy 20-25 good quality stocks. So then obviously the fund manager obviously has a role to play with respect to deciding which are the final 20-25 that go into the portfolio. So it's a teamwork. And as I said earlier, I mean, we're trying to institutionalize it by creating a structure. We are not there yet, but we should be there soon.
Put it short, and what I have understood is the research team for the mutual funds and the PMS and alternatives are safe. My understanding is correct?
No, as I said, we are working on that structure. We are not there yet. But
right.
So very soon, hopefully, we should be there.
Sure. Now I'll come to the ESG, which you have talked about. It has got just shy of little less than 2 billion now. And it is still a nascent and developing concept in India. And how this ESG is going to grow over time in 5-10 years? What is your outlook? And what is your input on someone who is interested in the ESG kind of fund?
Right. So, I mean, at the very basic level, ESG for us is not something very novel. I mean, for ages, people, when they invest, they've been focusing on sustainability. ESG is just one sort of label that you've put around sustainability. I mean, how does a business ensure that it's sustainable? Obviously, it has to make sure that it doesn't sort of get a lot of notices from the pollution control board. So it has to be environmentally conscious. It has to make sure that its employees and all stakeholders are motivated enough to perform. So, obviously it has to be socially conscious. And then, it has to make sure that it's not sort of doing any malpractices with respect to shortchanging minority shareholders and so on, or very inefficient capital allocation. So which is where governance comes in. So I think I won't sort of try to categorize ESG as something which is, different from conventional asset management. I think it's been a part of conventional asset management. And all we've seen over the last few years is that these episodes where, mishaps around some thing to do with environment or some labor strikes or everything have become significantly more prominent, not just in India, but across the world. And that in turn has led to, significantly renewed interest on this front. And I don't see any reason for that to change. I mean, climate change is for real. I mean, these things will have to be considered when you take any decision, whether economic or investments. So I think, this is here to stay. And this is always here. It's gotten a new name now. but we'll stay here forever.
See, this is a chat question which has come. Just what will happen? Manish Jain is asking this. What will happen in Eon Alpha if the Nifty index falls by 10% and the fund falls by 5%? What happens in this scenario?
Well, we follow the usual high watermark principle, which is that, the AUM has to be higher than the previous watermark. So once the client starts investing money, at least 100 rupees becomes the watermark. So till you are above 100, you obviously don't charge. So in this scenario, no fee is applicable. So it's both, the AUM has to be higher than the previous watermark AUM, and the difference between the fund's performance and the index's performance has to be higher than the previously charged performance. So both of them are applicable.
That answers even 𝐭𝐫𝐤𝐚𝐫𝐤𝐸's question also, which has come on the same subject. Okay, I'll get into the next question. The one is to Prashant Patel. I read out his question to you, Gaurav. As people say, it is impossible to catch the top or bottom. So there is a chance you can miss. I don't know what is when the scheme tried to do this. So there will be. I don't understand this question, and we will understand this question from Prashant Patel, and we'll get the answer for you from the fund house.
But I think, I broadly get the gist of it. Obviously exact tops and bottoms, no one will be able to capture. Right. And we don't say that we'll be able to do that as well. Which is why, the asset allocation framework that we use, all it does is it is counter-cyclical in nature. So as valuations keep on becoming expensive, it will ask you to keep reducing exposure. And similarly, when market sentiments become too high and too unsustainable, it will again ask you to reduce exposure. But does that mean that will it be able to catch the exact top? No, it will not. And which is why in any of these products, we are not claiming that these are some capital protection or absolute return products, right? We're saying that you are still carrying downside risk. All we're trying to do through this counter-cyclical approach to allocation is to reduce and mitigate those risks. So as I discussed in the AI product as well, that, we're not saying that when the index falls by 30%, we will not fall. We will fall. But all our attempt is that in these bigger drawdowns, we fall, let's say, close to half of the indexes fall. That's the objective. So that counter-cyclical approach will help, even though, we know that we'll never be able to time exact tops and bottoms.
Okay. This question, Gaurav, is from one Mr. Ganesh. Does ESG really matter? In an article, it has got very little impact on environment, and this is what Mr. Ashwath Damodaran his opinion to. And do you have any inputs on the opinion of Mr. Ashwath Damodaran?
I mean, I don't exactly know the exact details of the article being referred to. But as I said earlier, for us, ESG is focusing on sustainability. It's like saying that if all of us start smoking 100 cigarettes a day, is there any guarantee that we'll not live longer? No, there's no guarantee. Maybe we'll still live longer, but obviously that's not sustainable to healthy living. Similarly, I think for a company who's not being environmentally conscious or socially responsible or following right governance, sustainability will always be a very big question mark. And so as I said earlier also, right? I mean, that's something that we've anyways been focused on. So ESG does matter, sustainability does matter.
Next question, we'll move on. Nitin wants to know, is the scope of ESG funds inclined towards impact investing or towards seeking higher alpha or higher returns?
Yeah, that's an interesting question, because impact investing is taking ESG to the next level, right? What we are, however, focused on is to look at the listed company universe and at least make sure that companies that we are investing in are, clearing the ESG cutoffs. And as I said earlier, we are following external rating agencies with respect to ESG ratings, and we have an in-house ESG framework as well. We have a dedicated team focused only on ESG. So the company has to, do well on that ESG frame. And beyond that, what we do is obviously there's still a big subset of Indian companies that will do well on ESG framework. And then we follow our usual principles with respect to how to identify those 20-25 companies where we can still get very sizable outperformance over long periods. So in a way, it works in both ways. The fact that we've put an ESG filter helps at least mitigate accidents, if not completely avoid them, because you're focused so much on sustainability. But to the extent that this is still a large universe, and you have to just select a few ideas out of this large universe, you can still continue to focus on superior return generation. So it doesn't take away sort of from either.
He has got a follow-up question. I mean, Nitin, what is the weightage allocation you give for BMV, business management and valuation? What is the weightage you normally give?
Yeah, I mean, I wish I had a quantitative formula to sort of decide this. But, I mean, qualitatively put, I think B and M are the most important. So there's no doubt that we'll buy something which is not a good business or not a good management. But valuations is sometimes a matter of, the time horizon with which you're buying. For very long time frames, you can be somewhat relaxed on valuations. But, there's no quantitative formula here to decide. In fact, we again tend to focus on companies where B and M are right. And then, to the extent that we don't have to buy a lot of stocks, we then pick and choose where V is still making sense. But there's no formula, unfortunately.
I get into the last question here because we are out of time by 4 minutes already. The earnings season has started coming in, and in fact, what is your outlook? And generally, as pointed question, Reliance and ONGC will cover about 60-65% of Nifty profits. And do you think the scope for re-rating on the upside is available for other stocks? And 65% is coming from two companies, ONGC and Reliance.
Okay, so I mean, I unfortunately will not be able to go into stock specifics, but we do have so I mean, there are two ways to looking at earnings. One is what I covered already in the presentation, which is that after 12 years of secular decline, corporate earnings are finally looking through. So if you were to look at corporate earnings in India from a 3-year time frame, then we are very optimistic about earnings coming through. That said, we also run a macro model where we track a lot of macro variables like global money supply, local liquidity, credit spread, shape of the yield curve, and several such factors that we think eventually impact both economic activity and corporate earnings. And on that model, we are getting signs that the next 2 to 3 quarters, you will see some downtick versus what we've gotten used to over the past 2 years. So past 2 years, I think the index would have compounded at 25% per annum on earnings. I think that number could easily come down to early teens. Now, early teens, when you compare it to 4% Sensex earnings that we'd all gotten used to between 2008 and 20, even 12-13% will not look bad. But yeah, I mean, the problem, whether it's on inflation on one hand and the demand slowdown that high inflation causes. So the margin pressure that inflation causes and the demand slowdown that inflation causes is for real. But at this point, we're hoping that it'll take care of itself over the next 2-3 quarters. But yes, next 2-3 quarters, you should prepare yourself for a bit of a downtick versus what we've gotten used to over the last 8 quarters.
I must congratulate you when you packed 3 strategies into one presentation, which was first time I'm seeing. And you have answered all the questions in a very precise manner. I want to thank you, Gaurav, for your time, and I wish you well for on behalf of pmsbazaar, whatever endeavors you get into in the future also. While thanking you, I want to thank all the participants who have stayed and to hear this presentation. Thank you very much, all the participants. Thanks, Gaurav.
Thank you, Siva. Thanks, PMS Bazaar, and thanks to all the participants for dialing in. Thank you so much.